Good morning. Good morning, everybody. Good morning, Christopher.
Good morning.
Alexandre and Yost.
Morning.
So here we are. We are very happy and thrilled to have this session today. Let me first start by welcoming all of you to have this session on Iran context. We have the chance to have many people today online who answered very quickly to our invitation, business owners, CFOs, and international finance leaders with us. This presence shows how important this topic is for companies operating across borders. We consider our client that has been firm small and medium-sized multinationals or SMMs because our clients are operating abroad, facing being small in size means that when the world strikes, it can be hard. You're agile, but what's happening in the world can have. It's hard to make a full analysis. We try to deep dive a bit today, but we see that this conflict is already moving the USD oil prices, global. So for SMM finance leaders, there are decisions that may have to be taken in the coming days that can have direct impact on margin and cash flows. And that's where we are today. Before we start, a few quick housekeeping notes. First of all, this session is being recorded, and you will receive the full replay afterwards. Second, feel free to ask questions in the chat at any time. We'll try to address them. The rest will have some time at the end for the Q&A session. To be clear, this is a business impact briefing. It's political rate. Our focus is the economy, the market, and your operational. Okay, so now let's set the stage. In recent days, the escalation involving the United States, Israel, and Iran has created a new wave of uncertainty, politically and financially. We saw markets reacting immediately. Volatility jumped. Safe haven assets, energy price. Like always, we are seeing resilience. Major equity markets have held the ground. Liquidity remains solid. Investors to view this as a potential duration conflict, not a systematic market shock. History shows this pattern again and again, but very different. The two most important emotions and greed will try to influence our behavior. So, are we here to help us interpret for your business? Very proud to have two exceptional experts with us today. First of all, Christopher Dembik, market expert. Christopher will break down the macro picture, the market reactions, and the broader economics behind the lines. And Alexandre Laporte is a cross-border payment expert. Alexandre exposure, decisions making in certain situations, and share best practices. I was told that there has some problem with my
Microphone.
Headphones. Is that okay? Okay. Sorry. I will try then to. Hello?
I believe we lost David.
Yeah.
Maybe Christopher, you want to start?
Yeah, let's do it. Thank you a lot for letting me talking about this situation. Obviously, we see that the markets are a bit scared about what is happening in the Middle East. I would say as an introduction that we need to keep in mind that the market usually is a bit wrong about the expectation it might get worse. I will just give you some context. On my phone, on WhatsApp, I am with some groups of hedge funds, especially American hedge funds, and they start to freak out thinking that there will be liquidity issues, a new economic crisis, or a new financial crisis. But as David mentioned, if you look at the equity market or if you look at liquidity, actually, this is still going fine. So the most important, perhaps as introduction, and after we will have a question with David, it's just to understand that geopolitics usually have a very strong impact in the short term. And we see it especially in the Middle East, on the energy market. We see it also on the FX market, especially with the dollar. But in the medium long run, usually geopolitics does not have any strong impact. And I will give you only one figure. We had the 12 days war in June 2025, so between the US, Israel, and Iran. During the war, oil prices jumped by 15%. But as soon as the war was over, oil prices went back to pre-war levels. So this means that we need to understand it's not the end of the world, and especially when we hear the media, sometimes we could believe this will get very bad. Obviously, we don't know on the ground what's going to happen, and I guess even the US don't know it. But in terms of financial markets, it might be a tricky period, a lot of volatility, but once it's going to be over, I think we should still remain quite optimistic for this year. Typically, I'm not negative for economic activity at global level. I don't see a new period of stagflation. I think it won't change the roadmap we have in terms of economics and finance. I don't know if, David, you want to jump in? I don't know if your microphone is working.
Not sure. I'll let you go on.
It's good.
No, it's good.
Yeah.
Okay. Yeah, so maybe something interesting. How you see the difference between what we happened in 2025?
Well, when the war started in the Middle East this year, the market considered that it was exactly the same scenario than in June 2025, meaning you will have a few weeks of war, perhaps some destabilization, but it won't be a regional war. And on top of this, you won't have a strong disruption, especially on the energy market or even on the FX market. We see that the situation is getting a little bit worse in the short term. There is obviously the situation with Hormuz Strait, and if you can show the map of the Hormuz Strait, it might be interesting. This is very crucial, this strait for international trade and especially for the energy market. We have more or less 20% of global oil that is going through the strait. And often Iran said they will introduce a blocus of it. As a matter of fact, when we look at the latest satellite images, we see that there is almost no oil transiting through the strait. So it's not really because Iran is technically blocking it. It's mostly because a lot of freight companies are afraid to go through this passage. But the positive factor, it does not mean that 20% of global oil will be cut from the market. It will be a doomsday scenario, obviously. When you see on the map, actually for the oil market, you have other ways to try to distribute it. And you have especially one pipeline that is from the east and west of Saudi Arabia that can be used when you have a situation with Hormuz Strait. And especially this pipeline, of course, can be bombed by Iran. We know they have tried to do it, but so far it has been fortunately unsuccessful. But what is very important to understand, something happened after the Ukraine war. After the Ukraine war, we understood that you cannot have only one road for infrastructure, for energy, or for commodity, and so on. You need to have alternative roads. And we see it. There is this route with east and west oil pipeline that is something that can help actually to have oil from this area of the world that will still go to Europe, especially, or even to China. The second factor, we should also keep in mind that China is not directly involved in the situation, but China is a big player actually, because 80% of all the oil that is going through the strait is going to China. And China publicly called Iranians to reopen the strait. So all the doomsday scenario, and you have it probably if you read the newspaper saying, okay, this is the end of the world, we are facing a new oil shock like in the 1973. This won't happen, basically because China will pressure Iran, so they will get oil anyway. And the second factor is that you can also use other routes like this pipeline east and west from Saudi Arabia, which can be perfectly used. It has the capacity to transport a lot of oil. So geopolitics is always very complex, and we should not just believe that there is only one route for energy, and at the end of the day, if this route is blocked, there is a very negative factor. And that's why I think the market sometimes is a bit overreacting. When you see that you have these headlines about the Strait, you see obviously that investors, they are looking for safe haven, the US dollar, the Swiss franc, and so on. But again, what is important to keep in mind is, it's not as bad as the headlines show it. So there is a bit of overreaction in the market. But when you look at the bond market, why I'm talking about the bond market, because I think they usually price quite well the risk. And there is no panic on the bond market. We are not facing, there is even less panic than during the start of the Ukraine war. So that's why I think we need to understand it's not as bad as it looks like. It's not as bad as the headlines especially show it. And in terms of energy market, yes, you have a lot of volatility. It's normal, it makes sense. But at the end of the day, we will not be in a situation where we won't have access to oil or even gas.
Super interesting. Thank you, Christopher. Maybe before we go into the market impact, a few words on the Iran proxies, Hezbollah and Houthis, because they could impact also the context.
Yeah, well, the Hamas is not operational anymore. We know it. For the Houthis in Yemen, they're also facing a lot of pressure on bombing from Saudi Arabia. So yes, obviously they can disrupt the Red Sea passage, the Red Sea route. But we are used to this, I would say, and nowadays we have other alternative routes to use. Of course, it has a higher cost, especially because it's longer routes. So at the end of the day, the cost will be higher for the final clients. But it's not so big that it will create inflation typically, and it's not a new cost that will reduce margin, for instance. The main question mark was the Hezbollah in Lebanon. A few days ago, they launched an attack against Israel that was even criticized by the Lebanese government, but they have been bombed again by Israel. So I would say some headlines tell you that it will be a regional destabilization. It cannot really happen because all the proxy of Iran, they are not operational anymore. So they cannot really help much. When Hezbollah sent rockets on Israel, it was much more symbolic than anything else. So this is the positive factor. Yes, Iran is also bombing many other countries. Actually, 6-7 countries are bombed by Iran almost daily. It looks like it's very bad, but at the end of the day, we won't evolve in a situation where you will have a regional destabilization. I think this kind of doomsday scenario cannot happen actually. And even if Iran is able nowadays to bomb other countries, obviously because we have a lot of rockets, what you need to keep in mind, that I think it's quite clear, the US military hegemony there is no doubt about it. So it might take time. Trump is talking about the 4 weeks conflict. Perhaps it will be shorter, perhaps it will be longer. But at the end of the day, we should not believe that it will disrupt economic growth, financial markets, or even the FX market. I guess we'll go into deeper on the FX market later, but what was interesting is that you don't have so much volatility on the FX market when you look at even options. So actually, I think it's also another positive sign. No one is, I would say only the journalists are extremely negative nowadays, but at the end of the day, the markets are pretty calm given the situation.
So if we hear you well and based on your analysis, we are more in a sustainable, resilient expectation and resilient to sustain and to remain stable.
Yes, exactly. I mean, I think the markets are quite resilient, and we went through a lot. Remember, went through COVID, the Ukraine war, the high inflation, and so on. So the markets are quite resilient. I may jump just on a question on the chat because it was something I was talking about. If capacities are partially destroyed, then oil and gas prices may skyrocket. Yes, we know that Iran is looking to target oil and gas capacities in the Gulf states. They cannot destroy them, but they can clearly disrupt them. But the positive factor is that, yes, there will be a lot of volatility on energy prices. We see it on gas. Gas prices, I haven't checked the latest evolution, but gas prices increased by 50% almost. But what is important, can it last or is it a short-term effect? And in my view, it cannot last. Why? Because even if you disrupt oil and gas capacities in the Gulf states, remember something that is very important. Who is the main producer of oil and gas at global level? That's the United States. So in the worst case scenario, let's say you have such a big disruption that you don't have enough gas and oil on the market, then price will remain high for a long period of time. What the US will do, they will export much more oil and gas, and we can't do that. So we are not in the situation. I was listening. I was watching a French journalist a few days ago saying, "Okay, we are facing a new oil crash," but not at all. I mean, the geopolitics of oil has completely changed over the past 20 years. And nowadays, even if we have disruption, the US can temporarily, for a few months, produce and export much more oil and gas. So at the end of the day, oil and gas prices will go down. And just keep in mind that for oil and gas, the level of volatility is always much higher than on equity or than on FX. You will never see the Eurodollar jumping from 1.18 to 1.22 in 2 days. This kind of situation can happen in the oil market in 1 hour. But this is because this kind of market has always been much more volatile. But it's not because you have an increase of 50% of gas prices that you, as a company or as a consumer, household, you will have to pay 50% more because at the end, the price will mitigate. On my bet, I'm pretty sure of this, is once the war will be over, all this jump will be erased. Okay.
Super. I think we already jumped into the detail of the market impacts with the dynamics. Before we enter more into what our audience is they will move. What about the USD currency you want to comment on?
Yeah. I think this conflict is interesting because if you remember, let's say we would have this webinar in January. Everyone will tell you, I did not say that, but the common idea was to say we are in a period of de-dollarization. Some of them call it debasement trade. Basically, at the end of the day, what does it mean? It means you have a lack of trust in the US dollar. Because of Trump, because of all those kind of things, because of the high level of public debt in the US. I was always skeptical about this de-dollarization, debasement trade, because at the end of the day, I never saw it in the flow of capital. I still see investors are going to buy US assets. And what is interesting with the Iran war is we see that despite everything, the US dollar is still playing his role as a safe haven. And you can see, I mean, you don't have such a strong volatility, as I said, on the FX market. It's pretty stable. But we can see if we look at the Eurodollar, that obviously the Eurodollar is going down and the dollar is going up. The dollar is also going up against the Japanese yen. So at the end of the day, the market reacts always the same. The best safe haven at global level remains the US dollar. And I would add also the Swiss franc, because the Swiss franc is usually a good hedge in period of geopolitical risk. But it's always the same playbook. You see, but geopolitical risk in the FX market, I would say you always have the same playbook. There is only one exception, which is the Japanese yen. The Japanese currency did not benefit so much from geopolitics. Usually, it's also considered as a good hedge against geopolitics. I think it's mostly due to the fact that the Japanese central bank will probably not increase the hike anytime soon, probably only in the second part of this year. My bet on, and I consider this even before the Iran war, is I think the Japanese currency will remain weak for a very long period of time. But otherwise, the FX playbook is exactly the same than during each period of geopolitical risk. Dollar, Swiss franc, they are the best safe haven.
What about the gold?
Yeah.
Always safe havens too?
It's a good investment as well. Well, gold is increasing a lot. We have seen that initially gold increased just after the start of the war. It's a long upward trend for gold, because gold has been increasing over the past 2 or 3 years, quite sharply actually. How do we explain that? It's very basic, I would say. It's mostly because you have very small supply of gold, and on top of that, you have very high demand, mostly demand from central banks from emerging markets. What they want to do is nowadays, central banks of emerging markets, they have more or less 15% of exposure to gold. They want to have the same exposure than central banks of developed markets, which is more around 25%, 30%. So they buy a lot of gold. And of course, in period of geopolitical risk, sometimes, not always, gold is also a good hedge. It was not a good hedge when the Ukraine war started, because gold did not increase. So it's not automatic, but yes, at the moment it is playing its role. Forecasting is a tricky task. We know it very well at IBAN First, because forecasting for FX is always extremely complicated. But I would say for gold, for once, it's quite easy to know that gold will continue increasing in terms of price in the coming months and probably in the coming years.
Alex, not forecasting emissions of crosses, but after your talk. So we try to go through that. Talking about USD maybe. One word on the British people from the United Kingdom.
I could not hear you.
So, yeah, what about the GBP, the British pound?
Yeah. On the British pound, and I will jump on the Joshua's question as well after. On the British pound, it's a bit tricky, because if we look at British pound versus the dollar, my bet in the long run is that the GDP will increase. This is bright clear. Against why? Because I think the British pound is currently benefiting from this kind of debasement trade. People are worried about the US dollar. So once the war will be over, and it's a matter of weeks apparently, I think the sterling pound will keep increasing against the US dollar. At the beginning of the year, there was one call we had on the market that was the dollar will continue decreasing. And I think it will continue decreasing once the war will be over, and it will benefit to the sterling pound for sure. If we look at the cross euro versus sterling pound, this is another story. I think this cross is basically quite stable. We see there is not so much volatility, and I think like a fair level for the cross is at 0.87. So this is not something that I will expect with a lot of move. Usually it has been stable. I said forecasting in FX is always complicated, but for some cross, it's much more straightforward. There is also a question on the Swiss franc. Could the Swiss franc becomes a bit weaker in the coming month? This is a very good question. Once the war will be over, we start to see signs from the Swiss National Bank. They won't allow the Swiss franc to be so strong. We see it very clearly. I go very often in Switzerland. I have good connection there. The only question mark for the Swiss Central Bank is what to do. Usually what they have done in the past to weaken the Swiss franc was to intervene directly on the market, buying euro and dollar and selling Swiss franc. There is an issue with that because if they do that, they won't make the US government happy, and the US government, and we know Trump especially, will criticize the Swiss bank, and he will say they manipulate the currency, and it could get very ugly, especially because they have a trade agreement. So the Swiss National Bank might not do direct intervention on the FX market. It's a pity because usually they are quite successful when they do it. The other tool they may use on the money market start to price it. They might lower interest rates into negative territory. So we get back to negative rates. I don't think it will happen in the short term. Because the Swiss National Bank understand that currently we are in a period of geopolitical risk, so this is normal that the Swiss franc is stronger. But if the Swiss franc remains strong probably until the summer, I bet in September, in the second part of this year, they could cut interest rate in negative territory, and it's another tool to weaken the Swiss franc. So it's not a done deal that the Swiss franc will be strong all the year. And I think the central banks, we need to be careful that the central bank will not intervene. Usually they don't let us know in advance. So this is a risk to take into consideration. Not in the short term, in my view, probably in the second part of this year, but it was a very good question because this is something that we need to keep in mind. Well, we don't hear you, David.
Watching in Euro USD over the net.
We don't hear you.
Alex, can you ask the question?
I think it was on the Eurodollar.
Alex?
Yeah, sure.
Yeah, Eurodollar evolution in the coming weeks.
Okay.
Yeah, the Eurodollar evolution in the next 1 to 2 weeks, and what you believe will be the short-term bias if in the next 1 or 2 weeks.
Yeah, well, as long as the war remains in place, and we especially don't know what's going to be the next step, because at the end of the day, I think even the US, they don't know how to end this war. I think there will be still this, all the investors will look for assets in dollars, so which means the euro dollar will probably weaken a little bit more. I would say 1.14, 1.15 is a fair price in a period of geopolitical risk. I don't see it going down much more. I like to, and this is a good advice for everyone that is listening. You need to look always at the flow of capital. The flow of capital of investors, because it always has a very strong impact on the market. In January, we saw that most of the investors, they were looking to sell US assets, this debasement trade. Nowadays, when we look at flow of capital, and this is public data, so you can really get access to this, we see they are looking for US assets, mostly US bonds. So this is, of course, something that will make the US dollar quite strong in the short term. But the main story of this year, our main call, is that the US dollar will remain weak. If we look for the whole year, with always all being careful, I think for the Eurodollar, it could peak at 1.22. Why do I say 1.22 this year? Because 1.22 is a very strong technical level, and technical analysis is always helpful to try to see which levels we need to take into consideration. I don't think it can go beyond. I know some analysts expect the Eurodollar to go at 1.30. It's a very long road, I will say, so I don't see it happening this year for sure. But 1.22 is a fair price, and also in terms of fair value for the Eurodollar, we are around 1.80, so it makes sense in my view. But again, this 2 or 3 weeks period is probably an anomaly for the US dollar. It is getting stronger, but for the whole year, it will get weaker. The same situation, but yeah, please.
No, finish your sentence. Sorry, go on.
I don't think the same situation that last year will happen. The dollar index last year decreased by, I think, almost 12 or 13%. The last time it has happened, it was in 1973. So I don't think this situation going to happen. But for sure, there will be much more downside for the US dollar, the dollar index this year, because this debasement trade idea is still going on the market.
Thank you. Thanks a lot, Christopher, for helping us make sense of the geopolitical picture and the broader market dynamics. Now, let's shift gears from the macro to the operational reality, and I'm sure that our audience today is also very much in leaning towards understanding what to do in the coming days and weeks about your business, your currency, and the decision you need to make. Very pleased again to welcome our next speaker, Alexandre Laporte, one of the leading cross-border payment experts at IBAN First. You work daily with the small and medium multinational, small and medium companies doing business abroad, every day helping on navigating FX volatility, protecting margin, and at the end keep international payment flowing smoothly. So the question today is not theoretical. How to protect business margin and cash flow today. So maybe to introduce a first question, Alexandre, given the macro environment Christopher shared with us, what would be the recommendation about covering currency exposure? Wait for confirmation. What is your view on that, Alexandre?
Thank you, David. I think first is to take a step back and ask yourself the basic questions. By basic questions, I mean, why am I using FX, foreign exchange currencies in my commercial activity? Also, if I'm already doing so, why do I secure my FX exposure? I know it's really basic questions, but when it comes to this atypical moments with the conflict in Iran, I truly believe we need to go back to basic things, because the question you should ask yourself is what would be the impact for my business if the currency I need to buy my merchandise is increase by 10%. If tomorrow it costs 10 more percent to buy USD, and I need USD to buy my merchandises in Asia, for instance, or in the US, by the way, what will be the impact on my business? And same, if I do revenues, let's say outside of the Eurozone for European people, outside of the UK for British people, or outside of your accounting currency. Uh, and the country you make business with, you make revenue. Um, for some reasons, the currency drops by 10%. What's the impact on your activity? Because we talked about margins, pricing powers, competitiveness versus your direct competitors, and at the end, profitability. Uh, One comparison, uh, think about it. If you compare Hermes or Chanel with the entry-level branding clothes, definitely the impact of FX is not the same for the two companies. If I make things easier than the reality, because of course a company like Hermes, they do business in different currencies and all over the world. But let's say they produce in France in euro, and they sell in the US, to make it easy. Uh, if the if the USD drops by 10%, what they will do, they will increase the price of their bags by 20%, and everyone will be even more happy to buy a new bag. Uh, on the other side, if you take Primark, for instance, and I think Primark is from the UK, right? So if you take, thank you. If you take Primark and the cable, so the GBP USD uh, moves, and the USD costs 10% more, and they buy their merchandises in China, mainly in USD, they're not able to increase the price of the basic shirt, the white basic shirt, by 10 or 15%, because people will buy this shirt in another shop. So you see, the difference is really the the yes, the importance of FX exposure is really different whether you work in such industry, or your position in this industry is this one or that one. Um, Second thing, and I think it sounds with what Christopher explained, markets dislike uncertainty much more than bad news. If you think about it, the best bargains during the COVID period was at the very beginning of COVID. Why? Because at that moment, the uncertainty was at its highest, and 2 months later, 3 months later, we knew what was the situation. Okay, we have this virus. It kills this amount of people. Then we had a vaccine, etc. So of course the activity was not the same compared to a normal situation, but we knew what will happen, or at least we had a forecast on what will happen in the next quarters. But the very beginning of COVID, we had no clue. We were all like shocked by the situation, and that's exactly uh, when you have the best bargain in the markets. And I think it sounds with what Christopher mentioned about the oil price. No, the oil price is going up because we don't know. Maybe Iran, they have second weapons, and at the end they will make more damages that we expect. But the day the US will have secured this Hormuz situation, and the Iran regime will be down, we won't be in the same degree of uncertainty. Um, and to answer David's questions, I think the real question is, uh, what is the worst for me between, if I do I potentially lose 10%, or if I lose 7%, let's say, of opportunity. I mean, secure your business margin through secure your business your FX exposure. Sorry, it's not about predicting markets. It's about choosing which risk you are willing to take uh, between not secure your FX exposure and let the market do the things, or secure your FX exposure, and then you know what's your worst case scenario, and maybe you get something better at the end, but at least you know what is your worst case scenario, and you can focus on other topics more in line with your main activity. Um, and yeah, and I think that's it. I think that's it.
Okay. Maybe can you share what you've seen as the biggest mistakes you see today in the way company manage foreign exchange risk, and then some recommendation, because it's interesting to see what maybe people are failing to
Yep.
do.
Yep. Biggest mistakes, they are pretty the same as during other high volatility events. And they are the same as what the retailers they do when they invest for themselves. The number one is not sticking to your strategy, not sticking to your plan. You have a plan, and for some reasons, I mean, we have this conflict in Iran, and for some reason, you change your plan. That's probably the biggest mistake for me. Uh, Also, what I've seen so many times, and it's really frustrating for someone uh, who accompanying their clients every day, but it's being too greedy when the market is in your favor and overreacting when the market is not in your favor. If we take euro dollar, you are USD buyer versus euro. We have the euro dollar going up to, I don't know, 116 to 120, and suddenly the clients they don't want to secure their currency risk exposure, and they want to wait because maybe we get 122, so it's better than 120. Okay, indeed you're right, but your budget rate is at 117, and for weeks you told me that it's really bad to have this 116 and you don't know what to do, etc. And at some point there is this 120 from nowhere and you don't want it, you want to wait for it. I've
Yeah,
seen this too many times.
yeah.
um,
I think we can say that we have 10,000 clients at IBAN First. They are from many countries, to 12 offices in Europe and United Kingdoms, and from many different type of businesses, manufacturer, wholesalers. I mean, many industries. So I would say each case is different, obviously. Um, what would you say as a recommendation to our clients? To kind of go through that. The diversity of each case is different, and each case is specific.
uh, uh, w- Two advices that I'd like to share, uh, but the second one is in line with what you just said, David. But the first one is, uh, please understand that your time horizon is not Trump's time horizon, is not market times horizon. Uh, I mean, could Eurodollar go higher over the long term? Many analysts believe that on the long term, Eurodollar will be higher than today. But also, so if you only focus on this and you are USD buyer, you can assume that, okay, you know what, I will buy spot because on the long term it will be cheaper to buy USD versus today. But the truth is you make your financial statements once per year, so your profitability is measured once per year. I know it's not like this, but I mean I just make it easy for now. So it's true that on the long term, the main scenario, maybe it will be wrong, but the main scenario is Eurodollar to go up. But as Christopher also mentioned, uh, we have Eurodollar going down while most analysts believe it will go up this year. So can we imagine the highest point of 2026 was late January when we had somewhere around 120? That's possible. That's possible. I don't say it will be the case, but that's possible. So in that case, it means that as USD buyer versus euro, you would need to secure your FX exposure, even though on the very long term, you expect the dollars to be cheaper versus euro than today. So that's really important, this time horizon thing. Um, and there is something in the market. It, it's better to be half wrong with the right momentum rather than being right but too much in advance, because it means you're wrong, and that's also something very powerful in the market. Uh, Second thing, but I think David, you mentioned it. Second piece of advice: get support. Um, you know, that's my job for like 12 years now. When it comes to FX exposure, I believe I knew it very well, but I also know that finance is very large, and I'm a beginner in many aspects of finance. So I can imagine for CFO, CEO, treasurer, FX can be like super. I mean, it's not an easy game if it's not your daily job. So please get support at least once. At least once, take the time to discuss with an expert of what you are doing, why you are doing this, and share with this person, ideally someone at Ivan first, uh, what can be improved. Because once things are set up, then it's only execution. It's not. I don't say it's easy. I don't say it will be winning each and every time. Of course, it's markets, but at least you will not make it via emotion, because of emotion, but because of a plan. And you know the worst case of this plan, you know the best case of this plan. So you once again you can uh, pay attention on your business and not on this FX topic.
Mm.
I
This
think that's my
resonates very much.
typical.
Yeah, it resonates very much with what we hear from our clients, that having the right informations, which we provide on the platform, by the way, and being aware of economics and or type of content with you, Christopher, today, but also having a direct connection with an expert, Iban First expert and account manager, that you can talk, and they know your business, and they can help you to navigate. So I think it's a getting the right information and having support. I like the idea, and it's very much in line with our DNA at Ivan First. Um, we are already at time. I don't know. I don't have access to the chat. I don't know if we have a question on the chat we have not yet answered. Maybe getting one last minute to get a last question. One of you would be keen on to answering, or maybe Christopher, Alexandre, you want to add something before we wrap up?
There is the last question. I read it from Alessio Belia. It's a tough question, so sorry for, you will see with my answer, and it will fit what Alexandre said previously. Can you summarize what is your general idea about Eurodollar up to June, below 1.15 or up to 1.20? And I think, Alexandre, you mentioned it rightly. This kind of time frame on the market, it's extremely hard to know exactly what the currency will do. As we mentioned, the market consensus is the Eurodollar will increase after the war because there is this debasement trade against the dollar. I said, for me, a peak this year could be 1.22 because it is a very strong technical level. But again, to know if it will happen in June or later, it's extremely tricky. And typically, you can have so many events that are not priced on the market, and we are currently facing it, that things could change. But just to give you the idea, the trend, the market consensus, and I agree on that, is that the Eurodollar will probably increase this year due to the debasement trade. But again, keep an open-minded, keep being informed. And I think, Alexandre, you sum up quite well the situation. You have so many factors that you don't know, that are not priced, volatility, and so on. So always be careful regarding a very clear target. Usually, you can see it, and the clear targets on the market, and some analysts are doing it. It's part of their job to know at what level the currency or the cross will end up the year. Most of the time, we never reach the target. So we need to be very humble on the FX market, and to understand more which kind of scenario can happen, than to be sure only one will for sure happen. Usually, it's never like that.
Thank you. Thank you very much, Christopher and Alexandre, for your time. Thank you to the audience also for your attention. Hope we try to navigate through some of the macro environment, but also trying to be concrete and have actionable actions for our audience. So let's wrap up this call. Have a nice day and stay connected. Thank you.
Thank you a lot.
Bye-bye.
Bye-bye.
Thank
Bye.
you.
Bye.
Bye.